we are seeing the basic structure of Indian banking, and in the process we find that the structure is closely interspersed with and related to the history of banking from the pre-independence era, the nationalization, and State Bank of India coming into existence and all this. And came 2015. It's an era of technological revolution. We had a wonderful device called cell phone. The technological revolution in mobile has taken the economy of India to a different plateau, and banking is no exception. So we had to have banks which are tech savvy, which can operate efficiently and effectively through the mobile phones. Even though 2015 came with so much of technological changes and all, even then we had to have Jan Dhan Yojana to cover more than 30 crores of people who did not have bank accounts, who were away from the banking system. Therefore, to bring all these people effectively into the banking system, we needed new thinking, new instruments of banks, new variety of bank which are nimble, which are fast-footed, which are tech-savvy, which are least costly. And therefore, Reserve Bank of India came out with two different licenses because of the based on the budgetary proposal of 2015. In the budgetary proposal, the finance minister Arun Jaitley in 2015 said a new differentiated niche banks will be created. Based on this averment in the budget, Reserve Bank of India came out with two different banks called small banks and payment banks. So Reserve Bank opened the tap for giving the license for both kind of banks. Why two banks? Many people still don't know clearly what is the difference between a small bank and a payment bank. And why Reserve Bank should go for these two banks, why not with one bank? Now let us look into the differences between small bank and payment bank on a major level. First, small bank is a bank that operates in a local area, catering to all the requirements of the population there. They will do all banking services. In their services, they are not differentiated. They perform all the services of any nationalized bank or any private sector bank. They can offer all their services, but in a very local area, contiguous areas which are adjacent to each other. Payment bank, on the other hand, will be using lot of technology, mobile technology and all, and will cater to the floating population, will cater to the poorest sections of the society who have not had access, because a cell phone has reached even the nook and corner of India. And therefore, if there can be a bank which can reach the people through cell phones, that bank is payment bank. So we have both varieties of banks. Let us look at the essential differences between them. Small bank, they can accept deposit. There is no limit. On the other hand, payment bank also can accept deposit, but they have a limit of rupees 1 lakh per person. They can accept deposit up to only 1 lakh. They cannot accept 1 crore, 2 crore and all, because their target audience is different. They are the rural people, poor people who are spread far and wide in the country, and the floating population. And the second difference is small bank can accept all type of deposit. They can accept current account, they can accept savings bank, they can accept term deposits, they can accept recurring deposit, all. On the other hand, a payment bank can accept only demand deposit, which is savings bank and current account. They can either open a savings bank or current account. They cannot open fixed deposit or recurring deposit. The third major difference is that a small bank can provide loans and advances including credit card. They can issue a credit card, because when you issue a credit card, essentially it means you are extending some portion of credit to that customer. Therefore, they can give loans and also issue credit cards. On the other hand, payment bank is prohibited from giving any loan. All that they can do is they can only take deposits from the people, and then you have to, after reserve requirements, you have to keep the money, nearly the entire sum that is collected, in the Government of India bonds. They have to keep the money in Government of India bonds so that they de-risk themselves. So small bank can give loans and advances and also issue credit cards. Payment bank cannot provide a single rupee loan to any of its customer, nor can it issue a credit card. The fourth difference is eligibility. Who can open a small bank? A small bank can be opened by professionals with 10 years of experience in financial service, or a promoter group with a 5 years track record. On the other hand, payment bank has to be opened by card issuers, finance companies, business correspondents, telecom companies and retailers. So it will be best suited model for telecom companies. As a matter of fact, the first payment bank has already been started by Airtel. Then, the fifth difference is in the name. In the name of a small bank, you need not have to add the word small or any other word. Small bank will have its own name. For example, in Chennai, recently a new small bank has come. Its name is Equitas Bank Limited. You don't add the word small there. On the other hand, all payment banks must include in their name the word payment. That is why Postal Department, they have India Post Payment Bank Limited. So the word compulsorily, if it is a payment bank, the word payment must be compulsorily added to the name. So these are the fine differences between these two banks. But basically, these two banks are that the first small bank is to cater to the requirement of small and middle class people in a contiguous area. They will provide all kinds of banking services. On the other hand, a payment bank can only accept deposit up to 1 lakh. It can only accept a current account and a savings bank, and it cannot give any loan. And its target customers are the poorest of the poor people and the floating population of India. So now we are having all these banks are coming under the scheduled commercial banks. The small bank and payment banks, as and when they start operation, they will be, after verifying them, Reserve Bank of India will be including them in the second schedule. Thereafter, they will also become scheduled banks. Now, so far we have seen the structure of banking in India. As I told you, structure of banking in India is one of the best in the world because it has withstood the test of times. Have any of you, most of you are youngsters, maybe 26 or 27 years. In the last 26 or 27 years, have you heard of any bank failure in India? Have you heard of anybody losing 1 rupee because a bank failed? No. In the last 50, 60 years, ever since independence, nobody has lost a single rupee because of bank failure. Whereas in many countries all over the world, people have lost their entire savings. And even as great as America had to come to the rescue of banks in 2008 recession. Whereas India withstood the recession like solid rock. That is because of the beautiful structure of the bank. As I told, the commercial banks are controlled by the central government. And because of the arm's length difference between banks and the government, which is being maintained in India, which is one of the best features of India, which was introduced by Madam Indira Gandhi when she nationalized. She never appointed IAS officers as chairman of the bank or take over the bank and convert them into department of government department. A nationalized bank is not a government department. It is a separate entity. And she maintained the arm's length difference and she allowed independence. And as a result, the banking structure in India today is very strong. Whereas if you take China, what is the biggest problem of China? China started the banks in more or less the same way, but they made a fundamental mistake by converting them as a department of some government. So India's banking structure today is one of the best in the world, which is very strong and at the same time very resilient and ably and efficiently and superbly controlled and regulated by the great institution called Reserve Bank of India. We should thank them for the human service Reserve Bank of India has done to see that the banking structure and system in India is withstanding all the stress and strain of times and is able to look forward to fantastic growth in the days to come. Salute to Reserve Bank of India for this wonderful service. So having seen the structure of banks, let us now look at what is the share of business each kind of bank is having in India. Now I did a study of banks in Kenya. I found in Kenyan banking, the domestic banks have only 30 to 35% of the total business share, because foreign banks are having more than 65% of the banking business of Kenya. The domestic banks are having less than 35%. But on the other hand, look at the structure of Indian banks. I have given below you a pie chart. In the pie chart, if you look at, as of March 2015, State Bank of India Group has about 22% of the total deposits. Nationalized banks has about 51% of the total deposits. And the regional rural bank, which is part of the public sector bank, they have about 3% of the total deposit. So if you total all these things, it will be 51 plus 22, 73 plus 3, 76. More than 76% of the total deposits are with the public sector banks. The private sector banks, including both old and new, they have about 20%. It was earlier 13% because of the fierce expansive policies and the actions of the new private sector banks. From 13% they have grown to 20%. This is a growing sector. Private sector banks in the total business of India is growing. But what happened to foreign banks? Foreign banks have remained more or less static. It is 4%. They were at 5%, 4% level, and they continue to be 4% to 5% level, which means the Indian banks are very efficient, and the foreign banks, in spite of the so-called lot of money coming from abroad and their systems and tech savviness, they are not able to eat into the territory of public sector banks in a big way. If at all the public sector banks area is being taken away, it is being taken away by the private sector banks, who are our own homegrown banks. They are our own brothers. Therefore, the role of foreign banks in India is very, very negligible, running around less than 5%, whereas in economies like Kenya and all, it is more than 65%. This itself goes to prove the efficiency and the solidarity of the Indian banking system.